Welcome to this explainer. Today, we're going to hold a giant mirror up to your investing habits. We're using Howard Marks' legendary investment philosophy to expose exactly why you might just be your own worst enemy in the financial markets. Look, if you've ever bought a stock purely because it was going up, or if you've panicked and sold when everyone else was freaking out, you're definitely going to want to pay close attention to this.
All right, let's dive right into this masterclass. Here is our roadmap for today. We'll cover the most important thing, thinking beyond the crowd, value, price, and risk, the pendulum of the market, greed, fear, and ego, and finally, avoiding the pitfalls.
Section 1. The most important thing. To kick things off, we need to establish exactly why Howard Marks is a voice you absolutely must listen to. He's the co-founder of Oaktree Capital Management, a massive fund over in the US, and he brings 4 decades of hard-fought market experience to the table. His insights actually started as letters to his clients, where he'd repeatedly tell them, the most important thing is this. Eventually, he realized, well, there are actually a lot of most important things depending on where we are in the market cycle. And that realization formed the genesis of his entire philosophy.
Now, if you need proof of his credibility, just think about this for a second. When the literal god of the market, Warren Buffett, says he drops whatever he's doing to read someone's emails, you know those insights are pure gold. Honestly, if Buffett is taking notes, we should definitely be paying attention.
But here's the massive hurdle we all face. The economist John Kenneth Galbraith called it the brevity of the financial memory. Put simply, we suffer from financial amnesia. When the market is euphoric and money is just flowing effortlessly, your ego takes the wheel. You completely forget all the disciplined rules and guidelines you meticulously set for yourself. The worst lessons in investing are actually learned during the best of times, because all that euphoria totally blinds you to the impending crash.
Section 2. Thinking beyond the crowd. You know, what separates the average investor from the truly successful one really just comes down to the depth of their analysis. First-level thinking is super simple. It's looking at a famous company, seeing everyone buying it, and jumping right in. It's blindly following the crowd. But Howard Marks argues that the real life-changing money is made through what he calls second-level thinking. This means actively hunting for the hidden market inefficiencies that everyone else is ignoring. In a mostly efficient market, second-level thinkers are the ones out there digging for the great companies that have been temporarily discounted and completely forgotten by the media.
You have to actively force yourself to ask these counterintuitive questions. Think about a recent example with the company Oracle. They gave some amazing guidance, the stock shot up in a single day, and boom. Everyone rushed in, but shortly after, it crashed right back down to where it started. By just asking, hey, what if this popular stock fails to meet its estimates next quarter? You avoid those overcrowded trades, you step back, evaluate the downside, and protect your capital from entirely avoidable disasters.
Section 3. Value, price, and risk.
The absolutely crucial point here is understanding the distinct difference between price and value. They are not the same thing, especially when market momentum completely clouds your judgment. Imagine a car, say a nice Mercedes that costs $100,000. If that price suddenly jumps to $150,000 in a single week, you'd immediately say it's too expensive, and the value is gone, right? But in the stock market, when a price goes up, investors actually buy more. During the 2004 to 2006 madness, people bought purely because prices were rising, completely ignoring the fact that as the price goes up, the fundamental value shrinks and your risk skyrockets.
So, when we weigh asset quality against price, a really fascinating dynamic pops up. A historically great asset bought at a sky-high price is actually a highly risky investment. Meanwhile, an entirely average asset bought at a rock-bottom price can be very low risk. Consider the famous investor Mohnish Pabrai. Right after the COVID crash, he bought an Indian real estate company. Now, it wasn't considered a top-tier quality company, but it had this massive land bank in Mumbai and was selling for incredibly cheap. That absolute rock-bottom price completely removed the risk, creating massive value and exceptional returns.
You really have to meticulously manage risk the way a bank manages its loans. It's all about understanding, recognizing, and controlling it. For instance, you've got to beware of the castle of cards execution risk. That's where a business idea sounds amazing, but if the very first step fails, the entire investment goes to zero. And remember this profound insight from Marks: the exact moment you feel there is absolutely no risk in the market, when everyone around you is comfortable, that is precisely the most dangerous time to invest.
Moving on to Section 4, the pendulum of the market.
Let's see how market gravity builds and shifts over time. Rule number 1, and you should probably write this down: everything is cyclical. Industries, markets, even our own daily human emotions.
The absolute biggest risk you can take is looking at a current winning stock and extrapolating that upward trend forever. Because the stocks that led the last bull market, they are almost never the leaders of the next one. Markets operate strictly like a giant pendulum, constantly swinging violently between the extremes of crippling fear and euphoric greed.
And that pendulum has three very distinct stages. In a bull market, the wise men act quietly at the very beginning when things look incredibly bleak. Then, as things start to improve, the general public catches on and follows. Finally, at the euphoric peak, right before the inevitable crash, the fools aggressively buy in. Or as Warren Buffett bluntly puts it, when there is extreme greed, understand the market is about to collapse.
Section 5. Greed, Fear, and Ego.
This brings us directly to the vicious psychological traps that will actively destroy your wealth if they're left unchecked. You see, when you start making money, your risk aversion just plummets, and ego and pride completely take over. Envy is another massive killer. Seeing your neighbor get rich overnight makes you abandon all your rules. Then there's the terrible clone theory trap. You see a billionaire's portfolio and you decide to copy it. But here's the catch. You're seeing their mandatory public disclosures with a 3-month lag. You're literally buying their past moves at today's high prices, completely blind to what their exit strategy is. You end up buying high-priced risk without any foundational value, all because of FOMO.
The real antidote to all this noise is contrarianism. But be careful here. Being a true contrarian doesn't just mean blindly doing the exact opposite of whatever the crowd is doing. It means having the immense mental strength and courage to patiently study and find deep value in the places where the general public is entirely absent. It is incredibly tough. Why? Because you have to sit patiently on the sidelines while everyone around you is loudly boasting about making quick, exciting money.
$400 billion. Let that sink in for a second. That is the jaw-dropping amount of cash Warren Buffett has been patiently sitting on recently. The entire market is hitting new highs, FOMO and wild narratives are everywhere, yet he just sits quietly, waiting for the right value. It proves that sometimes the absolute best action in investing is no action at all. It is the ultimate test of mental strength.
Finally, Section 6. Avoiding the pitfalls. Let's distill all of this into the ultimate mindset shift you need for defensive long-term wealth creation. How do we actually avoid these ultimate pitfalls? Well, Howard Marks has a brilliant saying. There are old investors and there are bold investors, but there are no old, bold investors. Think about it. The bold, highly active investor frantically digs holes 365 days a year, like a laborer. They stress over every single daily market move just to earn a 20% return. Meanwhile, the old, seasoned investor, they play golf, read books, sit patiently in cash, make maybe 3 calculated moves a year, and earn that exact same 20% return. Wealth just isn't built by frantically jumping around to feel busy.
We also have to acknowledge the undeniable role of luck here. Napoleon Bonaparte famously said he'd much rather have a lucky general than a hard-working one. But in investing, luck only favors the prepared. If you don't do your exhaustive research first, you're just what author Nassim Taleb calls a lucky idiot, someone who made money totally without a plan and is basically destined to lose it eventually. You have to do the hard research first so that when luck finally strikes, you're in the exact right position to capitalize on it.
We're going to leave you with this final provocative thought from Howard Marks. When there is nothing particularly clever to do, the ultimate pitfall lies in insisting on being clever anyway. So, you have to ask yourself, are you going to keep frantically digging holes in the market just to feel busy? Or are you finally ready to master the uncommon common sense of sitting patiently? The choice is entirely yours. Thanks so much for joining us on this explainer, and we will see you next time.